Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Good afternoon and welcome. The show's Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm here locally in Valparaiso, Indiana, and managing money for clients in 25 states now. So we bring conversations that we have with our clients and with our team to this show, hopefully helping you add some value to your life and also your pocketbook. Ultimately, we want you to be able to save some money, put some money away, and invest your money wisely. And that's what we try to do here. So broadcasting today on WVLP 103.1 FM. Again, thank you to WVLP for the opportunity to be able to broadcast here locally. Tower goes to Maryville, Indiana, all the way to, starts getting a little sketchy around South Bend, but it broadcasts here in Northwestern Indiana. And then you can find us on any podcast wherever you pod. But Apple, Spotify, you name it, YouTube, as well as our YouTube channel at Farrell Wealth. You can find us on all socials at Farrell Wealth, and we'd love to hear from you. We try to make it very interactive. We have a number of people contact us and ask us questions about topics that they'd like us to discuss or like me to kind of go over. That's what we try to do on this show. You can find many of our latest episodes. I think we're on 190 now, but you can find them on our YouTube channel. And we talk everything from mortgages to realtors, real estate, all the way to Trump accounts and the new Trump accounts that are going on. Tomorrow, next week, we get a guest on the show. We have many guests on the show that are experts in their field, and I love being able to talk about what they're seeing in the business world in regards to activity and inventories and a number of different things that we can bring to you. Again, I always feel like some of the conversations I'm very privy to, I'm honored to be a part of, and I feel like I wish everybody could hear some of these things just because it just educates you and educates everyone to become better investors and become wise institutional investors as well as retail investors. So that's what we try to do here. Again, please contact us. Please reach out to us. You can find us at wvlp.org as well, streaming live right now. Here on the show, and then also we broadcast on 1 o'clock on Thursdays and then 3 o'clock on Saturdays, and then again obviously anywhere we pod. So I would love to hear from you. Also Greg at farrellwealth.com is my email, so please reach out. Overall, want to talk about really some amazing things going on today. Want to talk about last week, and then also, it's been the half of the year, so the end of the year, into the half year, July 1st is the end of the quarter. And then kind of want to talk about what's going on for the next 6 months. So in regards to the markets, in regards to investing, the Federal Reserve, and a number of different things. We just did a full show on the Federal Reserve. Check that out on our YouTube channel. But I just want to bring up the show. I can't start this July 8th show or July 9th show without recognizing the fact that I think the last week of pure American spirit and just fantastic esprit de corps as a country as we celebrated our 250th birthday, as well as the World Cup. I mean, obviously the result of the World Cup did not go as planned for sure. I think it would have been absolutely insane to get into to make it through the quarterfinals. It would have been incredible for all of us as Americans, for sure. We're definitely following the men's team and cheering for them, and then also just celebrating the fireworks shows and the celebrations that went throughout the nation were just absolutely incredible. And I hope you were able to enjoy them with you and your family. I hope everyone has 10 fingers after the festivities, watching the festivities in Washington, which is probably the largest fireworks show, certainly in my lifetime or ever will be. And also worldwide, many of our allies at the top of the list is Japan, with their festivities were incredible. And then you can kind of go across the world as well, as many of the festivities were celebrating us as 250th year. Festivities in New York were incredible and beautiful to watch. I hope you were able to check them out and be a part of it, because it really was just very, I don't know, it's just very, very proud nation that we have, and we live in an incredible country. And yes, everyone has blemishes for sure, but we are blessed to have been born here, to have been raised here, and to create a life, a family, and business here in America is just an absolute honor. And certainly was reflective in the celebrations that happened just recently. So way to go. We looked pretty amazing. You ask any of the Europeans that came over here that were celebrating the experiences that they saw here as they took a chance on coming to America for World Cup. Some of the amazing follows, whether you follow the personalities on different social media channels, and then ultimately many of them were invited to different concerts and different, even the White House. So that's been really, really cool to watch in regards to just innocent, everyday people as a fan coming to America and experiencing Buc-ee's and just all the different things that make us an amazing country. Not only the landscapes and the geography of our wonderful, vast country, but also the different things that we maybe take for granted. So it's been everything from ranch dressing to A1 sauce. So I just wanted to be able to mention something that's just good for everyone out there. As Americans, thank you for this wonderful country that we have. And hopefully this show can help you increase your wealth, and then ultimately maybe help out those fellow Americans with different things you might be able to do because you invest wisely and you learn some things on this show that have helped you along the way. So along the lines of the ships that sailed through New York and through obviously the bay, past the Statue of Liberty that just happened, many different countries brought their sail ships. I want to talk about the smooth seas that sometimes smooth seas do not make skillful sailors, as the saying goes. And when it comes to investing, there's really no time has been more true during the first half of the year. So I want to talk about the first half of the year and discuss some of the things that investors have been facing and what we've been facing as a wealth management firm and managing money for our clients. Is really investors face major events, including the war in Iran, which is obviously still ongoing. As of today, we've had another issue with the Strait, and the market has sold off a little bit, a little over 1% today. We'll see. There's a lot of still some saber rattling, but oil prices have pushed up. They've been pushing inflation to, at one point, multi-year highs. And the question's really about artificial intelligence as well as AI goes along and the future of that. All of these things have affected and made for murky, if not wavy, conditions in regards to the investments in the first 6 months. And yet markets have climbed to new all-time highs. Corporate earnings have grown to double digits paces, and many asset classes have really performed extremely well, considering all of these waves that we see and these murky waters. So the first 6 months have really been a reminder of the importance of staying invested and maintaining this longer time horizon that we preach about so much on the show. And the lesson is really perhaps even more important today, because the business cycle is now in its 7th year, while the market cycle is approaching its 5th. For investors to really kind of feel as if that same set of concerns have cycled in and out of focus, back and forth here of what we talked about, including inflation, up, now down, definitely come back immensely from just 2 years ago. The Fed, valuations, and all of these things can be so confusing to just everyday investors. And that's why we try to break it down here to make it real simple for you. But managing these conflicting challenges is just not just anything new. It's just a part of investing. And those who stay the course are rewarded in the long run. And I want to be able to make sure that you know that there's no doubt that there are unexpected events that happened, that certainly could happen in the second half of the year. These could be including, developments ongoing with the Middle East conflict and the the war in Iran, and the upcoming midterm election, which happens in November, the new market activities such as new IPOs. We saw SpaceX with their IPO. There are a number of IPOs that are slotted to come about here in the second half of the year. So, how can you as investors maintain a perspective as events unfold? And I want to talk about the key economic drivers that were in the first half and talk about things where we are and then where we're going. The S&P 500, the Nasdaq, and the Dow Jones Industrial have returned 9.6, 12.8, and 8.9% year to date through the end of June, respectively. And the second quarter has historically been strong for the S&P 500, returning 14.9, the Nasdaq at 21.4, and the Dow at 12.9%. So, it's been a really good beginning of the year. The US Aggregate Bond Index has risen 0.6% year to date, which is pretty pathetic. If you're a bond investor, it's been very difficult to find yield. We've talked about this on the show multiple times as far as finding yield for those conservative investors and also those pension plans, endowments that are mandated to invest in bonds and invest in treasuries. The bond index is only up 0.6, and that's just not going to get it done if you are a university and you're expecting to get a 4 to 5% return on your endowment with a sizable amount of private bonds. So the 10-year Treasury yield is into the second quarter at 4.47. That's risen from 4.17 at the start of the year. That is concerning. It has definitely risen. I feel like that is higher than it should be as to where things are as far as the economy, but the bond market sees something that I obviously don't. So, you want to be aware of that for sure. I would assume the 10-year would be closer to 4.3 or 4.2 or back to the 4.17, but currently 4.47 at the end of June. Just going overall developed international markets, they've gained 7.7. Emerging markets have returned 22.7 year to date, which is incredible. So obviously having a diversified portfolio and owning multiple different things has helped you. The commodities index has risen 12.3% year to date. And this is due to a strong first quarter, which experienced a gain of 23.3% in the overall quarter versus a decline of 8.9% in the second quarter. So things have definitely come off immensely in the second quarter for commodities. Brent crude peaked, as far as oil goes, peaked at $120 per barrel in May before closing the quarter at $73 a barrel, which is a huge help to everyone, consumers, businesses, you name it. Gold prices fell from $4,000 per ounce, while Bitcoin declined to a recent low of 58,000, currently trading around 61,000. But this is at the end of the quarter. Headline CPI rose to 4.2 year over year in May, and this was largely driven by energy prices at the time, which have obviously come back. Core CPI, which excludes food and energy, rose 2.9%. Just to update everybody, just as a reminder, the Federal Reserve kept rates unchanged at 3.5% to 3.75 through the first half of the year. And Kevin Warsh, as our new head of the Fed, was sworn as the new Fed chair in May. And again, we did a show on that as well. So that's the update in regards to 2026 for the first half of the year. And as I said, it's gone very, very well. It's so far so good. We'll see where things go. I think there's obviously a summer lull. A lot of people go on vacation. Many people travel to the Hamptons or wherever they go. From New York, sort of disappear for the summer, and the trade desk are manned typically by interns or junior traders, where everybody else goes and disappears for the summer and comes back. Usually September is when you kind of feel that everyone's back in the saddle and back in their chair. Real quick, just station identification. This shows Money Matters with Greg, and Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm, a financial advisor, and obviously owner of a wealth management firm that manages money for clients all over the nation. We're broadcasting on 103.1 WVLP FM. And also anywhere you pod. I also want to mention that I forgot to mention this, and this is for compliance sake. The opinions voiced in the show, program, and anything on Money Matters with Greg are for general information only, and they're not intended to provide specific advice or recommendations for any individual, and to determine which strategies and investments may be suitable for you. Please consult the appropriate qualified professional prior to making any decisions. Third-party guests are not affiliated with LPL Financial or Federal Wealth. So that's my disclaimer that I apologize. I should have done that at the beginning, but get the house cleaning out and get that out of the way. So talking about the rest of the year, it may be surprising to some investors that their current business cycle began in April 2020, amid the pandemic. So the market fell apart, dropped 38%. And we just passed the 6th anniversary in the second quarter here of this robust change since the pandemic and since we were shut down. And there have been several times when investors and economists worried that there might be another recession. That included when inflation peaked in 2022, which was insane, and when tariffs disrupted trade last year, which is just a year ago. Trading through trade war is one thing, trading through a real war is another thing. Through it all, the economy has been resilient and growing steadily despite these challenges. So the business cycle affects all aspects of investing and financial planning, from mortgage costs to annual pay raises. Everything's affected, and a healthy economy drives consumer spending. Business investment fuels corporate earnings and ultimately stock market returns. So while the stock market and the economy are not the same thing, they are often closely linked because they are. The chart that I will show in our blog, if you can go to our blog on feralwealth.com, and you'll see this also anywhere, or on our YouTube channel, you'll see the charts that I put up. Obviously not able to do that here on a podcast, but you'll see that the longest business cycles, including the one that began after the 2008 financial crisis and the 1990s during the dot-com boom, have lasted for a decade or longer. So, what's to say that this doesn't continue, and how is the economy doing today is the question. And one question we're asking all the time as we go through our investment committee meetings that we have as a team here to talk about where we're headed, how are things going, what chinks in the armor can we see, and are we seeing anything that is concerning for sure for our investors and for our clients. How's the economy doing today? Inflation is high, but could improve if oil prices remain low, for sure. And we fully expect that be the case. It's dropped from $120 in crude to now $73 and was just trading $67. So the job market has begun to heat up again, sort of reversing last year's concerns over a slow pace of hiring. The dollar has stabilized and rebounded more recently, and trade is still uncertain, but has stabilized in regards to many of the deals that have happened and the agreements that happened. Business investment has accelerated. You see multiple different countries as well as companies investing in America. All of that aside, consumers are feeling pretty pessimistic, which is amazing to me. But they kind of, even though they most of the polls say that they're pessimistic, they're continuing to spend on necessities and discretionary items. It's not like they're shutting down. And the economy appears to be healthy, despite some mixed signals, which is historically positive for financial markets, of course, in the long run. So many asset classes have performed extremely well because of this. And a variety of global asset classes have contributed to portfolios so far as being in those asset classes, like I talked about, being in a diversified portfolio. So these have continued from last year's trends and includes not only large cap stocks represented by the S&P 500, but also small caps have really come out about emerging markets and commodities. The second quarter in particular is one of the strongest on record, and that is saying something. And this is partly due to the timing of the war in Iran, which resulted in the market recovery, which began in the start of April. And that definitely contributed. There are many themes behind these returns, including the strength of the economy, hopes of a peace deal in Iran, enthusiasm around AI, and many of these factors are really driven corporate earnings growth, with profits rising over 20% in the past 12 months for the S&P 500 companies. That's incredible. This strong market environment has also led to a wave of high-profile IPOs, including the SpaceX in the second quarter, and really anticipated listings of OpenAI, Anthropic. Both AI companies are pending and on their way as far as their IPO. And while investors often focus on the first few days of an IPO when there's like the most headlines and the real benefits accrue basically over the longer period of time. So once you get a chance to be able to investigate and do your research in these companies that go from private to public, the benefit of these listings is that they broaden the opportunity that's set for all investors, which is especially important since many companies have been staying private longer due to regulations and multiple different things that have happened in the last few years. And many companies have just decided to stay private. Now, what matters most is how these businesses then perform over the years and decades that follow, and how they utilize the money and the influx of money from investors' money and going public, and what they do with it in the future. You can remember with Meta, which at the time was Facebook, went public and the stock immediately went below into the teens. They pivoted. They went from a desktop company in essence to a mobile company, and they used a lot of the money that they were given based on the going public towards that, and that really changed and transitioned them as a company. The largest technologies companies today, for instance, have grown over a long period through many market and economic cycles. So it takes time for many of these things to see themselves out. All of these positive trends do mean that the U.S. stock valuations are historically high. And the S&P 500 currently trades at a price-earning ratio of about 20 times, which is above the long-term historical average of 16 point. Now, that means that, like back in the dot-com boom, dot-com bust, back then, prices were high and there were no earnings. Now prices are high and there are earnings. And there's a lot of justification for the higher pricing because of the earnings that are coming about. So that's why we spend so much time watching the earnings numbers and the strength of earnings in regards to our companies that we want to invest in and the asset classes that we want to be in. So these valuation ratios really do not predict what the markets will do over the next year or two. Instead, they're really sort of a helpful guide in building long-term portfolios, especially considering other asset classes and overall risk management. But it's very important to pay attention to. So this year's asset class returns show the importance of maintaining a balance and being balanced overall as much as possible in a overall portfolio and an investment portfolio. One last thing I want to talk about before we close here is inflation remains a concern, but oil prices really have improved immensely. So I want to talk about the ups and downs of the conflict in Iran. They've definitely had a primary effect on the U.S. economy as well as energy markets. Disruptions to oil transportation through the strait pushed, Brent crude to nearly $120 a barrel before they pulled back. And as I mentioned before, they've fallen below $70. Right now, trading around 73, and they're up today based on new news. But gasoline prices have followed a similar path. And they always say, in the oil industry, I've always heard, rises like a rocket and falls like a feather. And that's exactly what's happening with gasoline prices have followed really a similar path on delayed basis, peaking around $4.50 a gallon before going below $4 here in Indiana. I mean, I just filled up my gas tank the other day for $2.88. So energy prices swings have directly impacted inflation rates. The consumer price index rose to 4.2 year over year in May. That's the highest reading in several years. And the gasoline component of that jumped 40% over the next same period. So core CPI, which excludes food and energy, rose at 2.9%. And this shows that inflation has really been concentrated in fuel prices and not yet on a broader phenomenon. If you've noticed, egg prices are not what they used to be. Things have come down. And many other things have come down in regards to prices too. It's not as insane as it was just a couple of years ago. So with oil prices falling recently, many economists hope that the near peak inflation levels, so that we're near those peak inflation levels, and this is similar to past geopolitical shocks we've seen that have affected the supply of oil. Sudden, as you look back at Russia's invasion into the Ukraine in 2022, and many other situations. Once they've stabilized, have often improved, and they're bringing inflation right down below. And then one last thing, just mention volatility. Look, investors have grown very accustomed to brief periods of volatility because of macroeconomic events. It's between tariffs and Middle East conflict and uncertainty around the Fed and elections. I can go on and on about the different things that we've seen and what I've seen in my career for sure. But these events really have these short-lived market swings, and it's just best to kind of focus, on, getting rid of the noise, not listening to the noise, and just paying attention and having your discipline. That's, you can be seen in the VIX index and the volatility index as a common measure of stock volatility. As it spikes, people get very nervous, and currently the VIX is reading at about 16. That's below the long-term average of 18.4. And it's well below the recent peaks that we've seen. So you're just seeing a lot of, calmness coming back into the market, a lot of data being the data-driven market, which is what we want. We don't want Washington wagging the market's tail and vice versa. We want the market to be left alone if we can possibly have our way. And as regards investments, just let us do our thing. And another way to think of how the market really moves that affects investors via the largest pullback of the year. So far, the S&P's largest pullback to like the peak to trough decline, basically from the high to the low, has been 9%. Now, while pullbacks like these are never pleasant, markets really tend to rebound when investors least expect it. So today, not only has the market fully recovered from its earlier pullback, but the S&P 500 has reached 24 new all-time highs so far this year. So look, the first half of the year demonstrates that the most important risk for investors navigating these episodes back and forth of this volatility itself, is not the volatility itself, but it's how you react to them. It's tempting to try to time the market during times of periods of uncertainty. This often backfires. So instead, it's better to hold on to a portfolio that's designed to withstand all the parts of a market cycle while serving long-term financial goals and taking advantage of some of these opportunities and these asset classes you might not have access to. Now might be a time where you might want to add more or get into some of the asset classes we talked about. So when you're doing this, investors can better prepare for the inevitable periods of uncertainty to the second half in the year. So it's important to stay invested. And one of the effects of investors exiting the market during periods of volatility is often referred to as cash on the sidelines. So the primary problem with this strategy is knowing when to get back in. And that is very, very difficult for many investment advisors, investment managers, as well as everyday retail investors. Money market funds have reached a record $7.9 trillion currently. And that's more than double than the pre-pandemic levels when interest rates were nearly zero. So this reflects both market uncertainty over the past few years, but also certain higher short-term rates that make cash a little bit more attractive. But while cash may feel safe and stable on paper, the challenge is that cash yields often do not offset inflation. And so, for instance, the current average rates on certificates of CDs mean that the real income from cash is currently negative after adjusting for inflation. So imagine that. You go into a CD and you're actually losing money. So even with nominal yields on money market funds and short-term interest rates instruments really appearing more attractive, there can be challenges due to inflation. So you want to make sure you don't want to erode your cash holdings over time. And historically, this is why it's important to hold a balanced portfolio that can benefit growth, income generation, capital preservation.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.